Hello everyone, in this video today we're going to be going through the topic of reversing entries. So first, just to start off, we're just going to go through the basics of reversing entries. So basically the first thing we would want to know is, what is a reversing entry? Well, just definitionally, a reversing entry is a journal entry made on the first day of an accounting period that reverses an adjusting entry made on the previous day. Okay, so basically it just reverses out an adjusting entry made on the day, literally the day right before this reversing entry. Okay, so as an example, if we have a calendar year company, which is a company with a December 31 year end, they make reversing entries on January 1st. Okay, so it's literally the day after the adjusting entries are made. That's when we make reversing entries. All right, so it is important to note that a company gets the same end result whether it uses reversing entries or not. Right, so if we use reversing entries or we don't use reversing entries, it doesn't make a difference. We end up in the same spot, right? And so that's important to note, because otherwise we would not be allowed to use reversing entries, right? If it was a situation where we ended up in a different place, then with using reversing entries versus not using reversing entries, we wouldn't be allowed to use reversing entries, if that makes sense, okay? So companies make two types of reversing entries. Basically, companies reverse all accruals, and then companies reverse deferrals when an expense or revenue account was debited or credited when the original cash transaction took place. This is just kind of definitional, just an FYI. Whether or not you would really need to know that, whether or not that would be tested. It might be tested, it might not. It's just that you kind of need to know that on just a definitional basis, okay? So that's sort of just something you should memorize, okay? Next, why do companies use reversing entries? Well, companies make reversing entries to simplify the accounting associated with certain types of transactions, such as these accruals and deferrals that we just talked about, okay? And it's most helpful for large companies that have a lot of the same type of transaction. You know, think of like a Walmart or, you know, an Amazon or something like that, right? A company that just has a ton of the same type of transaction. It's helpful for these type of companies to simplify their accounting, okay? Now, for accruals, companies make a reversing entry so that they can always credit cash when paying off an expense or debit cash when receiving a revenue. That's how it helps them simplify the accounting process, is that they can always know that whenever they're paying off an expense, okay, we just credit cash for the full amount of the expense, and then on the revenue side, we always just debit cash for the full amount of the revenue. Okay, we never have to worry about receivables or payables, right? So basically what this means is you never worry about a payable, and that would be on the expense side, or a receivable, right? So obviously a payable would be for the expense side, a receivable would be for the revenue side, okay? On the other hand, we have deferrals, which is, you know, the opposite, I guess you could say, of an accrual. So a deferral, we have companies make a reversing entry so that they will not have to make another adjusting entry at the end of the second year, okay? And so we'll see what that means when we go through an example. All right, so how do reversing entries work? And this is on the accrual side. Okay, so we're first going to go through the accruals. Well, companies using reversing entries perform the following steps when making a reversing entry for an accrual. Okay, so at year end, the company makes an adjusting entry to record the economic event that took place but is not yet recorded. Right, so that's one of the things that we have. That's an issue that we have with accruals. Right, is that something happens. Right, so for an example, there are salaries earned but not yet paid. You debit salaries expense, you credit salaries payable, right? So in this case, these employees worked, but they were not yet paid. And so what happens is that the economic events have taken place, but we haven't recorded them. We haven't actually paid these employees cash, okay? Right here it says economic events take place, right? These employees did work, but we haven't paid them. So we have to accrue this liability, right? This is the adjusting entry, right? This is an adjusting entry, okay? And this is not specific to reversing entries, but I'm just including it here so the other entries make sense. Okay, this adjusting entry is made whether or not you would have reversing entries or not using reversing entries. Okay, but the first step is you record your adjusting entry, and this is for an expense, right? But you could have the same thing for a revenue, but we're just going through an example with an expense. The very next day, the company records a reversing entry that uses the exact same accounts and amounts as the adjusting entry, with the credit and the debit flipped. Okay, so when we use this salaries and wages payable example, the reversing entry is salaries and wages payable as the debit, and then XX, salaries and wages expense as the credit, right? If we literally just go back to the previous page, at the very bottom, we see the adjusting entry, the expense is debited, and then the payable is actually credited, right? But if we flip to the next page, the payable is the one credited and the expense, the payable is the one debited and the expense is the one credited. Sorry, let's just go through that again. The expense is debited here, payable is credited here. Here, the payable is debited. Here, the expense is credited, right? So what we're doing is literally just undoing what we did the previous day, right? That's what a reversing entry does. Okay. So then when we look, so then the reason that this will make it simpler, right? The reason this makes it that's very crooked. Let me just readjust that. Okay. So what happens is the reason this makes this easier is because when we debit off this payable, right, this makes the balance in the payable 0, right? Because what we would have had was that we would have had this payable outstanding, okay? As of December 31, we would have credited this for XX, however much. You want to say it's $100, say it's $100, doesn't make a difference, okay? And then on January 1, we actually zero out the account, okay? So then what happens is when we go to actually pay these employees, okay? When we actually go to pay these employees, we can just, credit cash for the full amount, okay? And then we know that we're just going to debit salaries and wages expense for the full amount. We don't have to worry about whether or not there's this salaries and wages payable on the books, okay? We're not worried about that anymore because we just took it off the books here. We took the payable off the books, so we don't have to worry about it in the future. That's how it kind of simplifies the accounting, okay? And so that's how you can kind of see if you have a company like Walmart or Amazon or something and they're doing millions of these transactions a day, you can see why it's simplifying it, right? Because otherwise, every other payable they would have, they'd have to worry about, okay, is there a payable outstanding, yes or no? And then take that off the books first and then do the rest of the expense. But in this case, we take the payable off the book the first day. We don't have to worry about it anymore. We just debit expense for the full amount of the cash that we pay out when we actually pay these employees, okay? How do reversing entries work on the deferral side? Well, it's a little different, okay? So companies using reversing entries perform the following steps for making reversing entries for deferrals, okay? So when we have this first initial cash transaction taking place, the company debits or credits cash, and they either debit or credit, they either debit an expense account or credit a revenue account. This is different from what we learned in ACG 2021, okay? So let's see how this is different, right? What does this mean in words? It's kind of like vague, but when we see an example, it makes more sense. So let's say we have this example. This company prepays insurance expense. We see they're debiting insurance expense and they're crediting cash. This is prepaying insurance expense, right? So normally in 2021, this would have said prepaid, insurance, right? We would have literally just called this prepaid insurance. This would have been an asset account, right? But here we're actually expensing the entire amount, right? And that seems wrong at first, right? However, as we can see in this note here, it says, note that this journal entry would expense the entire amount paid in cash, which is the entire amount of the insurance, right? Which is wrong if we don't correct it, right? It says, which is fine as long as we have the correct balance at year end, right? Which means we make an adjusting entry to correct what we did before, right? And so this is a different way of doing it, which we see in this class when we use reversing entries, okay? So when we have reversing entries, this company is going to go ahead and just literally debit the entire amount of the cash that they pay for this insurance to insurance expense, okay? They actually expense the entire amount up front. And then we actually make an adjusting entry to correct that at year end, okay? Again, pretty different than 2021. Might take some time to sink in, but that's just our first exposure and we will go through another problem, okay? At year end, so this is the second part. So we had the first part. We have our initial cash transaction. Part 2, at year end, the company will determine how much expense it has incurred during the year, and then they record an adjusting entry. Okay, so they record an adjusting entry. All right, so using the prepaid insurance expense example that we have above, the adjusting entry is what? Okay, we're going to debit prepaid insurance, and we're going to credit insurance expense. Okay, and that will make sense in the future once we go through a problem. But basically, really quickly, what's going on is that you recorded too much expense in this first one. Assuming that you have some insurance left over for future years, you recorded too much expense in the previous entry. So you're actually crediting an expense, meaning you're reducing the balance in the expense, and then you're increasing the balance in a prepaid insurance account, meaning like, okay, we have a certain amount of insurance going forward. Okay, and we'll see examples of a deferral very similar to this in a future problem, and it will make more sense then, hopefully. Okay. The very next day, the company and then this is the third step. The very next day, the company records a reversing entry that uses the exact same accounts and amounts as the adjusting entry with the debit and the credit flipped. Okay. So continuing with this example that we have, the reversing entry, right? Very important with the terminology. That's why I have them underlined, reversing, adjusting every single time, because we need to know the names of these. We need to know exactly what an adjusting entry is, exactly what a reversing entry is. They're not the same thing, right? So the very next day, okay, we record this journal entry where it's literally the same accounts and amounts as the entry above. You can just see that prepaid insurance is now credited where it was debited before, and expense is now debited and it was credited before, right? And so it literally is just basically undoing. It's reversing, right? It's reversing. That's where the name comes from. The entry that we made the day before. Okay, so that's just sort of the basics. Now we have a couple of problems that we're going to go through. Okay, so now we're just going to walk through sort of an extended example of how this works with T accounts and everything, so we can make sure that these concepts are like really sort of that they make sense. Okay, so first we have an accrual example. So the first part is that we're gonna use reversing entries, okay, in this first example. All right, so first assume that XYZ company pays its employees on a bi-weekly basis. And then additionally, assume that the employees earn a total of $10,000 per week, right? So they're earning $10,000 a week and they're paid on a bi-weekly basis. And we are using reversing entries, right? On an exam or a quiz or whatever, if they want you to use reversing entries, it's going to be very specific in the problem and say, okay, use reversing entries. Okay, so now assuming that the employees worked 1 week for which they had not been paid for as of December 31 of 2017, XYZ records the following adjusting entry, right? So we're at the end of the year, they haven't paid these people. We have to say, okay, they worked 1 week, they make $10,000, salaries expense $10,000, salaries payable $10,000. Okay, that's a pretty regular adjusting entry. Okay, now on January 1st of 2018, XYZ makes the following reversing entry. Okay, so as we talked about before, it's the exact same amounts, right? So we see it's $10,000 and $10,000, okay, going out the door. Sorry, not going out the door, but $10,000 is the debit and the credit. It's the exact same amounts. It's just that the payable used to be a credit, now it's a debit. The expense used to be a debit, now it's a credit. Okay, it's literally just reversing out what we did before. Okay, now on January 8th of the next year, XYZ makes the following entry when they pay their employees, right? So another week has passed. That means they owe these employees $20,000, okay? Now, what I was talking about before, XYZ can just literally just debit salaries expense for the full $20,000 and then credit cash for $20,000. Okay, that should say $20,000. Okay, so credit cash for $20,000 when they're actually paying off these employees. All right, and so they're literally just saying, okay, we've actually taken off the payable, right? Because what happened was that we had this payable outstanding, right, as of the end of the year, and we know it's $10,000. We can literally just look and see that it's $10,000, and then on January 1st, we just take off the payable, which means it has a zero balance, right? It actually shows this down here at the bottom as well, right? We had $10,000 that we accrued, okay? And then we have a $10,000 ending balance. We take off the balance, so we end up with zero as our balance when we actually pay off these employees, okay? So we don't have to take that off the books. It's easier because we just expense it all, okay? Then on the salaries expense side, we'll see, okay, we accrue $10,000 at year end. Okay, we have to close this account, right? So assuming there's no other expenses, we actually have to close the expense accounts. So that means we end up with zero ending balance. And an expense account, it's a revenue account. Or sorry, if it's a revenue or an expense account, it has to be zero at the end of the year, right? We have to actually close it out in the closing process that we talked about in chapter 3. And so basically what happens is then the next day, right, we, on January 1st, so this would have happened 12/31. And then on 1/1 of 18, we would see that we would have to actually credit salaries expense, right? We credit salaries expense for $10,000, okay? And then on January 8th of 2018, we debit salaries expense for $20,000, which is shown in this journal entry right here, right? It's just the debit. We end up with $10,000 of salaries expense as of January 8th of 2018, which is correct, right? Because we only have $10,000 of additional expense that takes place in 2018. Okay, we only have $10,000 of expense because only 1 week passes, right? And if they're making $10,000 a week, we should have $10,000 of expense. Okay, Now let's compare this to the exact same problem, and we're going to compare everything to this next problem, just assuming that they don't use reversing entries. Okay, so it's the exact same facts. Okay, so again, these companies are paid on a bi-weekly basis and they make $10,000 a year. So December 31 of 2017, XYZ makes the following adjusting entry. They debit salaries expense for $10,000 and they credit salaries payable for $10,000. It's literally the same entry. We can flip back and just see. The adjusting entry doesn't change, right? So the adjusting entry does not change when we're looking at accruals. On the deferral side, it can potentially be a little bit different, but on the accrual side, it's the exact same entry. Okay, that's not different. Okay, then we're not using reversing entries. Okay, so on January 1st, XYZ doesn't make an entry. There's no entry to make because they're not reversing out what they did before. Okay, now on January 8th, they actually pay off the employees. Okay, so now this is where that salaries and wages payable has to come off the books first. XYZ has to search their books. They have to say, do we have a payable outstanding for this specific expense? Oh, yes, we do. Okay, fine, we'll take that off. Then we have to record $10,000 of extra expense, and then we credit out the cash, right? And that's very different than this entry here, right? Because first of all, there is a reversing entry under the reversing entry example, and then here we just literally debited salaries expense for the full $20,000, right? We didn't have to worry about, okay, is there a payable outstanding and all that type of stuff. Okay, but here we do have to worry about the payable. That's why it's more simple under the reversing entries, using the reversing entries. That's why it's more simplified. And again, this may seem trivial because it's just one payable and we can keep track of it, but imagine if it's a large company, right? It's a Walmart or it's an Amazon or something, and they've got millions of these things outstanding, right? It's very difficult to make sure that you're keeping up with it, right? Okay, so let's just look at the T accounts, and then what we're going to do is that we're going to compare across both of them, across both scenarios, meaning with reversing entries and without reversing entries, and then we're going to see if we get the same results. Okay, so first, salaries expenses debited for $10,000 for the adjusting entry. We see that right there. Then we have to close it out, right? We have to close out our expense accounts. We end up with a zero balance. Okay. Then salaries expense. The only other entry is that we debit it for $10,000 when we actually pay it out, right? We see that right here. That's that one right there. That's the debit. We're just posting that. Okay, so we end up with $10,000. Okay. Then on the salaries payable side, we see, okay, there's a credit for $10,000 on December 31. We see that right there. Then we don't have to close it, so we just have zero. We don't close. We do not close our balance sheet accounts, right? So we end up with a $10,000 balance as of December 31st of 2017. Then on January 8th, we can see right here we debit off $10,000 of salaries payable. So that means we have a zero ending balance, right? So let's just compare and see what we have. Okay, so for 2017, okay, we recorded $10,000 of expense and closed that out under the with reversing entries. Under without reversing entries, okay, we did the exact same thing, right? We recorded $10,000, closed it out. Then under the without reversing entry side, okay, we do a $10,000 credit and then a $20,000 debit to this salaries expense, which leaves us with a net expense of $10,000. Okay, that's the important part. We record net expense of $10,000. We end with $10,000. Okay, on this one we do the same thing. It's just we have less journal entries. We record $10,000 of expense. We have $10,000 of expense. Okay, so we see it's literally the exact same thing at the end of the day. Okay, then salaries and wages payable. Okay, we credit it as of December 31st, and then we have a $10,000 ending balance. We'll see it's literally the same thing right here. We credit for $10,000, have a $10,000 ending balance. Then we end up debiting off the payable as of January 1st, and we end up with zero ending balance. Over here, we debit off the payable. It is on January 1st. It's a different date. Doesn't make a difference. We still end up with zero. Okay, as of 2018. Okay, so if there were no other transactions in 2018, we would see that 2018 would have a balance of $10,000 in salaries expense as a debit, zero for salaries payable, and then literally the exact same balances, $10,000 for salaries expense and zero for salaries payable. We're going to go through the other problem in another video, so look for that very soon.